Let me ask you something. Your grandparents or maybe your great-grandparents worked for 30 years, got a gold watch, and then got a check in the mail every month until they died. They didn't have to think about investment portfolios or asset allocation or safe withdrawal rates. They just showed up, they worked, they retired. So here's what I want to know: what happened? Because if you're in your 30s, 40s, or even your 50s right now and you're trying to plan for retirement, you probably feel like you're carrying a weight that previous generations never had to carry. And the frustrating part: nobody really explains why. People tell you to max out your 401k, buy index funds, avoid lattes, and then act like that's the whole story. It isn't. In this video, I'm going to show you the real reason retirement gets harder with every generation that comes along. Not the surface level stuff, the structural stuff. The stuff that happened at a policy level, an economic level, and a cultural level that quietly shifted the entire retirement burden from institutions onto individuals. And here's why this matters to you directly. If you don't understand why the game is harder, you can't play it well. You'll keep trying to win a rigged version of the old game while the rules have completely changed around you. By the end of this video, you're going to see the full picture clearly, and you're going to walk away with a framework that actually fits the world you live in, not the one your grandparents lived in. Let's get into it. To understand where we are, you have to understand where we were. For most of the 20th century, retirement in America and in many developed countries was built on what's called a defined benefit plan. A pension. Here's how it worked. You worked for a company for 20 or 30 years, and in exchange, they promised you a specific monthly income for the rest of your life when you stopped working. The company was responsible for investing the money, managing the risk, and making sure the math worked out. You didn't have to know anything about stocks or bonds. You just had to show up and do your job. Add Social Security on top of that, which was designed as a supplement, not a replacement, but still provided a meaningful baseline, and most workers had 2 guaranteed income streams waiting for them in retirement. Not perfect, not lavish, but predictable. Now here's where things start to change. In 1978, Congress passed something called the Revenue Act, which included a small provision, Section 401k, that was originally designed as a tax loophole for executives. It allowed employees to defer a portion of their salary into a savings account on a pre-tax basis. At the time, nobody thought it was going to revolutionize American retirement. It was an afterthought. But then companies started to notice something. Managing pension funds was expensive, complicated, and carried enormous long-term liability. If their employees lived longer than expected, or if their investments underperformed, the company was on the hook. The 401k offered a way out. Instead of promising workers a specific monthly income forever, companies could just contribute a set amount to an account, and after that, the risk was entirely the employee's problem. Through the 1980s and 1990s, the shift happened fast. Employers started freezing or eliminating pension plans and replacing them with 401ks. By 2019, only 15% of private sector workers had access to a traditional pension, compared to 35% in the early 1990s. In a single generation, the financial architecture of retirement in America was fundamentally dismantled and rebuilt, except the new version transferred all of the risk, all of the complexity, and all of the responsibility to workers who were never trained to handle it. Think about what that actually means. A pension manager is a professional. They have a team of analysts, decades of experience, and legal fiduciary obligations to the people depending on that fund. When you put a 28-year-old marketing associate in charge of their own retirement account and hand them a list of mutual funds to choose from, that is not the same thing. That is not even close to the same thing. And it's not just about expertise, it's about psychology. When you're responsible for your own retirement, every financial decision you make, every job change, every year you delay contributing, every market downturn you panic through, directly affects the quality of your life in old age. The stakes couldn't be higher, and the tools most people have to manage those stakes couldn't be more inadequate. This was the first crack, but it wasn't the only one. Here is a number I want you to sit with. Between 1979 and 2020, worker productivity in the United States increased by 61.8%. In that same period, the hourly compensation of typical workers grew by just 17.5%. Let me say that again. Workers produced 62% more. They were paid 17.5% more. That gap between what workers produce and what they're actually paid is not an accident. It's the result of decades of policy decisions, declining union membership, globalization, and the increasing power of capital over labor. And what it means for retirement is brutal. You are trying to save for a future that costs more, using wages that haven't kept up with the past. Now let's look at where the money actually has to go. Housing is the most obvious pressure point. In 1970, the median home price in the United States was roughly $23,000. Adjusted for inflation, that's about $170,000 in today's dollars. The actual median home price in early 2024 was over $400,000. That's not inflation. That's a structural shift in how expensive it is to have a place to live, and it means younger workers are spending a far larger share of their income on housing than their parents did. Money spent on a mortgage or rent is money not going into retirement savings. Healthcare is the second crushing weight. In 1960, the average American spent about 5% of their income on healthcare. Today, that figure is closer to 18% for the country as a whole, and for individuals, especially retirees, the numbers are even more stark. Fidelity estimates that the average couple retiring today will need approximately $315,000 set aside just for healthcare costs in retirement, not counting long-term care. That number alone is larger than the total retirement savings of the majority of American workers. And then there's education. The average student loan debt for graduates in 2023 was around $37,000. For many people, that debt follows them well into their 30s and 40s, directly competing with retirement savings during the exact years when compound interest works hardest in your favor. Starting to save at 35 instead of 25 isn't just a 10-year delay. Because of compounding, it can mean arriving at retirement with less than half the money you would have had otherwise. So what does this add up to? It means that for a person in their 30s today, a significantly larger percentage of their income is being consumed by housing, healthcare, and debt than it was for someone of the same age 2 or 3 generations ago. The money available to save for retirement in real, inflation-adjusted terms is smaller. The costs waiting for them in retirement are larger, and the institutional safety nets that used to bridge that gap have been systematically removed. This is not about personal failure. This is about structural arithmetic. Here's one of those facts that sounds like good news until you think about it hard. In 1935, when Franklin Roosevelt signed Social Security into law, the average life expectancy in the United States was 61 years. The retirement age was set at 65. In other words, the system was designed at a time when most people were statistically expected to die before they even collected a single check. The few who did live past 65 were not expected to live much longer. Today, a 65-year-old American can expect to live on average to about 84, and that's just the average. If you make it to 65 in reasonable health, the odds are meaningful that you'll live into your 90s. The fastest growing demographic in the United States is people over 85. Now, if you retire at 65 and live to 90, you need 25 years of income. If you retire at 62, which nearly half of Americans do, often involuntarily due to health or job loss, you need nearly 30 years of income with no paycheck coming in. Financial planners have a term for this: longevity risk, the risk that you outlive your money, and the deeper you go into it, the more uncomfortable it gets. Here's why it matters so much. Traditional financial planning used to operate on a 4% rule, the idea that if you withdrew 4% of your portfolio per year in retirement, historically your money would last 30 years. That rule was developed in the 1990s in a period of higher interest rates and different market conditions. Many financial experts today argue that 3% or even 3.5% is safer given current conditions. A seemingly small difference in withdrawal rate has a massive effect on how much you actually need to save. At a 4% withdrawal rate, you need $1 million saved to generate $40,000 per year. At a 3% withdrawal rate, you need $1.33 million to generate the same $40,000 per year. That gap, $330,000, is enormous. For most people, it's years of savings, and it emerges directly from the fact that you might live longer than the old models assumed. The brutal irony here is that medical advances are simultaneously increasing your lifespan and your healthcare costs. The longer you live, the more likely you are to need expensive care in your final years. Long-term care, assisted living, nursing homes, memory care can easily run $80,000 to $100,000 per year or more. Medicare doesn't cover most of it, and most people drastically underestimate the probability that they'll need it. When your grandparents retired, a 15 or 20-year retirement was the expectation and the plan. You may need to plan for 30, the institutions haven't adjusted, the policies haven't adjusted, and most people's savings habits, to the extent they're saving at all, haven't adjusted either. Let's talk about inflation, not the way economists talk about it in textbooks, but the way it actually operates on a retirement plan over 25 years. Inflation is essentially a slow, quiet tax on savings. Every year that money sits in low-yield accounts while inflation erodes purchasing power, you're getting poorer without spending a dollar. And the compounding effect of inflation over a long retirement is something most people fundamentally underestimate. At a 3% inflation rate, which is roughly the historical average in the US over the last century, your purchasing power gets cut in half approximately every 24 years. That means if you retire at 65 with $50,000 per year in income, and you live to 89, the real value of that income has been cut nearly in half. The groceries, the utilities, the medical bills, the rent, all of those have roughly doubled in price, but your fixed income has stayed flat. This is particularly devastating for people who rely heavily on Social Security or fixed annuities, both of which have limited or no cost of living adjustments built in. The Social Security COLA, cost of living adjustment, is indexed to CPI, but research has consistently shown that the way CPI is calculated often underestimates the actual cost increases faced by retirees, particularly in healthcare, which consumes a disproportionate share of a retiree's budget. And here's where it gets generationally worse. The inflation experienced by retirees in the 2020s, when the US saw inflation spike above 8% in 2022, the highest in 40 years, hit people on fixed incomes especially hard. If you're a worker, higher inflation usually comes with higher wages, eventually. If you're a retiree drawing down a fixed portfolio, there is no wage increase coming. You absorb the full hit. The practical takeaway is this: building inflation protection into your retirement plan is not optional. It's one of the core variables. And yet most people, when they think about having enough money for retirement, are thinking in today's dollars, not in the inflated dollars they'll actually be spending 20 or 30 years from now. Everything we've talked about so far has been financial and structural, but there's a dimension to the modern retirement crisis that doesn't show up in the numbers: the psychological burden of being entirely responsible for your own financial future. This is harder to quantify, but it's very real, and it makes everything else worse. When pensions were the norm, retirement planning required almost no decisions from the average worker. You showed up, you worked, you contributed automatically, and the system handled the rest. Decision-making and risk were centralized in professionals who were equipped to handle them. Under the 401(k) system, every worker is now their own chief investment officer. You have to decide how much to save. You have to decide how to allocate your investments. You have to decide when to change that allocation as you get closer to retirement. You have to decide whether to take Social Security at 62 or 67 or 70, a decision with enormous long-term financial implications that most people make with almost no guidance. You have to decide what to do during a market crash. You have to decide how to convert accumulated savings into income in retirement, a completely different problem from accumulation that most people never even think about until they're right up against it. Research in behavioral finance has consistently shown that human beings are not naturally good at these kinds of decisions. We are wired for short-term thinking. We panic during market downturns and sell at the worst possible time. We experience present bias, meaning we vastly prefer a small reward today over a large reward in 30 years, which makes it psychologically difficult to sacrifice current spending for distant security. We are overconfident about our own financial knowledge, and we are deeply avoidant about things that make us anxious, which means that many people simply don't engage with retirement planning at all because the topic feels overwhelming or hopeless. The financial industry hasn't exactly helped. It has a long history of exploiting this complexity through hyphy products, confusing disclosures, and advice that serves the advisor's interests more than the client's. The rise of fee-only financial planning has improved things somewhat, but access to genuinely independent, high-quality financial advice remains concentrated among the wealthy, the people who need it least. The result is a system that demands sophisticated financial decision-making from people who were never educated for it, never trained for it, and are already overwhelmed by the other demands of modern life. That's not a failure of individuals, that's a failure of system design. None of what I've said above is designed to make you feel helpless. It's designed to make you clear-eyed. Because if you understand the real problem, you can build a real response to it. Here's what actually matters. Start earlier than you think you need to and automate it. The single most powerful variable in retirement savings is time. Because of compound growth, a dollar saved at 25 is worth dramatically more than a dollar saved at 45. If your employer offers a 401k match, contribute enough to get the full match at minimum. That's an immediate 50% or 100% return on your money before it's even invested. Set the contribution to increase automatically each year. Remove the decision from your daily awareness as much as possible. Think in terms of income, not balance. Most people frame retirement as I need to save $X, but the more useful frame is I need to replace $Y per month in income for potentially 30 years in an environment where costs will be higher. Work backwards from that number. It's a harder conversation to have with yourself, but it's the right conversation. Account for healthcare seriously. This is the number most people exclude from their retirement estimates because it feels abstract. It isn't. Budget for it explicitly. Consider a health savings account if you have access to one. It is the single most tax-advantaged savings vehicle in the U.S. tax code and can be used specifically for healthcare costs in retirement. Delay Social Security if you can. Claiming Social Security at 62 versus 70 can result in a difference of 76% in your monthly benefit. For every year you delay claiming between 62 and 70, your benefit grows. If you're in good health and have other sources of income to bridge the gap, delaying is almost always mathematically superior. It's also the most powerful tool most people have for managing longevity risk because a higher Social Security benefit is guaranteed, inflation-adjusted income for life. Diversify against inflation. Holding assets that historically outpace inflation equities, real estate, tips, treasury, inflation-protected securities is not optional for a long retirement. A portfolio that's too conservative may feel safe, but is quietly losing purchasing power every year. The risk of running out of money is just as real as the risk of losing money in the market. Don't conflate volatility with risk while ignoring inflation. Think about housing as a financial asset. For many people, their home is their largest asset. How and when you use that asset in retirement, whether through downsizing, renting, or reverse mortgage, is a major retirement planning variable that often gets treated as an afterthought. Be honest about the gap and close it incrementally. If you're behind on saving, and many people are, for reasons that are largely structural and not their fault, the worst thing you can do is ignore it. A clear-eyed assessment of where you are versus where you need to be, followed by consistent incremental improvement, is more effective than either panic or avoidance. Let me bring this back to where we started. Your grandparents didn't retire comfortably because they were smarter or more disciplined than you. They retired comfortably because the system they worked within was designed to support retirement. They had pensions that guaranteed income. They had a social security system that was well-funded relative to the number of people drawing from it. They had housing costs and healthcare costs that consumed a manageable fraction of their income. They lived in a period when wages grew roughly in line with productivity, and when corporate employers felt an obligation to their workforce's long-term well-being. That system was dismantled, methodically, over decades, through policy choices and corporate decisions that transferred risk from institutions to individuals. Nobody handed you a memo, nobody explained the new rules, they just changed them and expected you to figure it out. The reason retirement gets harder every generation is not because people are getting lazier or more irresponsible with money. It's because the architecture of retirement has been gutted and replaced with a system that requires professional-level financial knowledge, perfect psychological discipline, high income, and good timing, and then acts surprised when most people fall short. Understanding this doesn't let any of us off the hook for our own decisions. It does mean we can stop framing this as a purely personal failing and start engaging with it as the systemic problem it actually is, both in our own financial planning and in how we vote, how we advocate, and how we think about policy. The people who will retire with dignity in the coming decades will be the ones who understood the new game, accepted the rules they couldn't change, relentlessly changed the ones they could, and started as early and as deliberately as possible. That can be you, but it starts with seeing the full picture clearly. With that said, thanks for watching, and until next time.